QuickBooks Pro Desktop 2021, Profit and Loss, P&L, Income Statement, Overview. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our Get Great Guitars practice file. We currently have the Open Windows open. You can open the Open Windows by going to the View dropdown, selecting the Open Windows list. We're now going to be opening the income statement, or the profit and loss, or the P&L report. Three names for, in essence, the same report. A very important report, one of the two major financial reports. So when you think about the reports in general, you want to think balance sheet, income statement, main reports, and then all other reports, basically supplemental, giving more detail on some line item that will be on the balance sheet or income statement. To open it, we're going to go to the reports dropdown. Company and financial, then you can go to the profit and loss standard, or you could go to the reports drop down and simply go to the report center. Once in the report center, I'm going to maximize it over here. I'm going to maximize the report center. We want to be in the standard tab to the left, company and financial. The first items in the company and financial will be the income statement type items, first report, and those items being the profit and loss standard. That's the one we want. So I'm going to go ahead and run the profit and loss standard, P&L standard, also known as the income statement. I'm going to change the dates up top from 01/01/21 to 12/31/21. That's going to be January through December for the year of 2021. We have seen the balance sheet in prior presentations, so I want to compare and contrast this to the other major report, that being the balance sheet. So let's open that up too. I'm going to open that up with the drop downs, going to the reports drop down, company and financial, and I want to go to the balance sheet standard report. So balance sheet standard report, this one only having one date to fill out here. That's 12/31/21, because this is as of a point in time. I would also like to open the trial balance. The trial balance basically stacking the balance sheet on top of the income statement and removing the subtotals. Very useful report to get used to using. I'm going to go to the reports drop down. We're going to go to the accounting and taxes, open up the trial balance report. And I'm going to change the date range here from 01/01/21 to 12/31/21. There's going to be our trial balance. One last thing to open up, and that's going to be the general ledger information as well, or our chart of accounts, I should say, our chart of accounts. So I'm going to go up to the lists up top, and I want to take a look at the chart of accounts. Lists, chart of accounts. So notice that this chart of accounts is going to be something that will typically be set up when you set up the QuickBooks file, often be provided by QuickBooks based on the industry that you are in, and then you can add to it and whatnot as you go. The accounts that are in use, the accounts that have activity within them, then any account that has activity will then be shown somewhere on our two major financial statement reports, balance sheet and income statement. So you can think about it from top to bottom, as this is recorded in by type, balance sheet and then income statement type reports. We can see them stacked up, balance sheet and then the profit and loss. Note that the trial balance is basically stacking balance sheet, then profit and loss, but removing the subtotals. That's what the trial balance looks like. In other words, assets, then liabilities, then equity, and then income and expenses will be the accounts on the trial balance. So we're going to be focusing into the profit and loss. So going back to the P&L, notice that the P&L is another name for the income statement. So that's the first thing to note with QuickBooks. They use the term profit and loss, or P&L type report for short. If you learn financial accounting, you're going to learn income statement. So this is going to be like the income statement, just a terminology that you're going to have to get used to. You can, of course, change the name if you wanted to in our customized reports, and we'll take a look at that later. It could help you to kind of stand out if you're working with clients that like the term income statement versus profit and loss, whatever people are used to. You can make those adjustments if you so choose. Now, the profit and loss report is going to be the activity report. It's going to show how we did over time, a performance type report. The majority of the reports are going to be performance type of reports. So this is going to be saying, what did we do over a time period, as opposed to the balance sheet, as we saw, which is showing us as of a point in time. So no matter what I do with the beginning date here, there is no beginning date range here, but you can put a beginning date range in here. No matter what I do in the beginning date range, the end date, whatever the end date is, that's going to determine what the actual report looks like. So this report won't be affected by the beginning date because it's as of a point in time, this being 12/31/2021. So it could be for the month ended, it could be for the year ended, it could be for the day ended. It would still be the same report on the balance sheet side. On the income statement side, the beginning date, of course, matters, because we're trying to see basically if you're thinking about this in terms or analogizing it to a distance type of thing, trying to see how many miles you can drive, for example, in an hour, then you got to basically reset the odometer every time you try to see how many miles you can drive in an hour, and then you'll count up from that point. So in other words, we reset the odometer here in terms of how many dollars can we make and how many expenses does it take in order for us to make those dollars. We reset the odometer in January, and then we're counting up through December. And remember that this whole report will then feed into the balance sheet. In other words, the bottom line of this report, the 6132, then that's the activity, the summary breaking down into one number of how we did over the last year. That number then is going to be on the balance sheet as of this point in time in the equity section. QuickBooks actually breaking it out in the equity section. Okay, so let's go back to the profit and loss. Let's do the same kind of thing we did with the balance sheet. Let's minimize all the categories and then maximize the categories and think about them from category to category. So I'm going to minimize the triangles here. I'm going to minimize all the triangles. And I'm going to go from lowest to highest minimization. So we got the income. And so there we have it. And so we've got everything broken down as tight as we can here. So the major categories are going to be ordinary income and expenses. That's basically the income statement. Everything on the income statement is generally basically either an income account or an expense account. And so this top portion is basically the entire income statement, revenue minus the expenses. So if I open then this one up, the top component is going to be the income type of accounts. Those are included in income. If I break this out, then now we have the accounts within the income accounts. So this whole category is ordinary income and expenses, which is basically almost the entire income statement, although we'll talk about the category other income in a second. And then within it, we've got the income and then the expenses down below. Now these down to this section now are going to be the categories that the account categories or account types they're called. So we can see those in the chart of accounts. If I go to the chart of accounts and I go down to the income areas, so after equity, then we have income, balance sheet, items, assets, liabilities, equity, and then income. These are income type accounts. That's how QuickBooks gets this little drop down. If I go back to the profit and loss, this little drop down is dropping down by the type of category, and we have our income categorizations. Now, the income categorizations are usually fairly limited. You may only have one categorization of income because you basically specialize in doing one thing. Now, there's a temptation oftentimes to be breaking out the income into subcategories that are too detailed. For example, you might have the inclination to basically break down your income by who pays you, by customer. You don't want to do that. You don't want to create another income account by your customers, because we can break out a sub report that will tell us our income by customers. So resist the urge to do that. You want to have a very limited amount of income accounts. You also might think about breaking your income account into what you sell, like the types of inventory you sell or something like that. Again, you want to limit the amount of doing that because you can make sub reports. You can make other reports that can give you that kind of breakout. So notice we do have some categorization here. We have the sales kind of information, which is selling inventory versus service. And then we did break out some service items that are more particular, such as guitar lessons. So we broke out guitar lessons here into another income category, but we didn't break out guitar lessons by guitar instructor, for example, because that would be a little bit more too detailed. We can find that possibly in another report. We also had rental income here for rental equipment, which again, we broke out in another category instead of just putting it into like service, but we're not breaking it out by what type of things we rent, because that would probably be too detailed for the P&L profit and loss report. Now remember that the general income kind of categorizations, you can call the income line items whatever you want, but usually if you sell inventory, like if you sell actually physical inventory, then you've got sales. It's often called sales. If you sell service items, such as if you're a law firm, a legal firm, or a bookkeeping firm or something like that, then you might just call it revenue, you might call it income, you might call it service income, bookkeeping income, or sometimes they call it fees income because you're collecting fees. But the primary thing is that you have it set up as an income type of account, and you'll be increasing the income as you collect basically the income. That's going to be the increasing side, and that's the goal of the company in general, when you think of it from an accounting system, that is revenue generation. All the rest of this expenses side, the expenses are there in order to help you to achieve the goal of revenue generation. So we have another subcategory of expenses, that being cost of goods sold. Cost of goods sold is only there if you sell inventory and you're tracking the inventory. Well, it's only there if you sell inventory. If you sell inventory, you're going to have cost of goods sold, which is the cost of the inventory that you're going to be selling. If you sell inventory, then the cost of goods sold is usually a very substantial expense that you will have there. It's going to be one of your largest expenses oftentimes. So that's going to be the cost of goods sold line item. And once again, if we go back to the chart of accounts, we could see that account type breaking out here in the cost of goods sold. So we have another account type. That's why you have the drop down for the cost of goods sold on the P&L report. And then we have all the other expenses. If you have a service company and not have inventory, then you're going to group all your expenses basically in other expenses down here. So everything else is in other expenses. This will typically be the longest component of all your reports in terms of types of accounts, because you specialize in what you do. Therefore, your income accounts are typically going to be limited, and then everything else you pay for. So you want to break out your expenses by, the thing that you're paying for or the use that you have for that expense. So for example, when you pay the phone bill, you might pay it to Verizon in our case. We're going to put it into the category, however, of telephone expense. So we're breaking this out by basically what it's going to be used for the telephone expense. Payroll, obviously, we're not breaking that out by employees. We're breaking it out by what the category is, which was the description of what we're paying in general, which is the payroll expense, internet expense, and so on and so forth. Now, the expenses note that is the area of the most confusing that you will have, because when you're making payments, you're often going to be saying, okay, what expense account should this fall under? If I'm paying some new vendor, where should it go within the expense accounts? So when you're starting out the company, the general rule would be, well, first of all, if you're taking over the books from somebody else and somebody else had been running the books before, then you want to make sure that at least at the start, you're being consistent. You'll be able to see what happened last time, and you could use the same account so you have consistency. And then you can make changes if you think you can improve the system going forward. If you're starting out a new QuickBooks file, then typically you're going to have your chart of accounts over here that will be provided to you by QuickBooks given the industry that you're in. And basically they'll have the expenses lined up here, and you can then see if there's an expense that is applicable to you for the particular vendor that you are paying. If there is, I would use it. If there is, and you want to change the name of it, then you can go in here and right click and edit the account and simply change the name instead of adding a new account. If there's no expense account here at all, then you can basically add a new account. But I would go through that process, otherwise your chart of accounts will get too long. You'll have too much activity going on. Once you have done that for a couple months, then you might want to go into your expense accounts here and basically maybe delete the ones that QuickBooks has provided you that you're not using, so that you can limit your number of expense accounts. That's often one of the problems the bookkeeper is always going to have, is how much detail do I want to have in the expenses. Some people like very little detail, which is too little, meaning you could just group everything into expenses, right? Yeah, I just grouped everything into one category. It's expenses, telephone, utility, it's all just expenses. Well, that's a little too not broken out. And other people will tend to break out every little thing here. Every time they have a new vendor, they break out another account, and they're going to have way too much detail for someone more detail than you need in order to break out all the expenses here. So you want to find that happy medium. Normally you find that happy medium by following the standards per the industry, and oftentimes you can do that by copying the QuickBooks chart of accounts and using it. Now note that if you wanted to then look at the accounts that you were using and like delete or make inactive the accounts that you were not using, you can go to the customized reports up top. You can take a look at the advanced items here, and you can say, I want to look at display me all accounts, even if they're not being used, and say okay, and then okay. And now all the zero accounts are here. So these are accounts that QuickBooks set up that are in your industry that are not being used. You could find those accounts then on your chart of accounts And if you wanted to then delete an account, you can delete it if there were no activity to it, or you can right click and edit it, and you can make it inactive by saying inactive here, so it will not appear in that way unless you reactivate it. So I'm going to close it back up and then go back to the P&L. I'm gonna remove the 0 accounts, customize reports. I'm going to revert back to the norm. And so we're back here, and then I'm going to change the dates again, 01/01/21 to 12/31/21. Now, the other issue you might have down here with your expenses is going to be that you want to have some more categorizations, some more subcategorizations. There's a couple different types of subcategorizations you might end up having. For example, you might have different locations, and you have your expenses, and you'd like to kind of break out those different locations. One way you could do the different locations and break out that more detail is with the use of classes. We're not going to get into a lot of detail with the classes here, but we might add another section after the practice problem to take a look at the classes, and that'll basically allow you to assign an expense account to a class, which will give you a different column here, breaking out the expenses by column if you so choose. You can find the classes by going to the Edit dropdown, going to Preferences. You want to go into Accounting, and then you want to go into Company Preferences, and then turn on the class tracking. Turn on class tracking, and that'll do it. If you do that, then you'll have to basically assign a class every time you enter a transaction to an expense account or an income statement account, so that it knows to show up in the right column. Another way that you can do this is you might have sub-accounts, and that's going to be what we did here with the depreciation. So we might say, within depreciation, I would like to have some sub-accounts here to give us some more detail of it and be able to collapse those sub-accounts. So this triangle, unlike the triangles above it, is not driven by simply the different account type, but rather it's driven by the sub-account. So if I go back to the chart of accounts, for example, we set it up here as a sub-account. We got the depreciation, and these are sub-accounts. If I right-click on it and edit that account, then we can see that that's going to be a sub-account of the depreciation account, which gives us that nice little breakout. So those are your two options. Many people really like the sub-accounts, but that's another area where you can kind of get carried away. If you have a lot of sub-accounts, then you're increasing the size of your income statement a lot. But the bottom line of the income statement is fairly straightforward. That's how straightforward basically it is. You're going to have income minus expenses. It's just how you want to categorize that income and expenses to give you the more detail that you might want without having basically overwhelming detail. That will give us the net income. Now notice we have a subtotal down here, which is going to be net ordinary income. That's income before we have the line items below, and we might want to put some line items below that are not typical to like the normal business operations. And that gives us another kind of look to be able to say, hey, look, this is revenue minus expenses of what we actually do for our business, like the normal business operations. If you want to compare this to what's going to happen in the future, then this is our normal performance. And then down here, we got some kind of stuff that's not really part of our normal operations. It's income and expense, but you can't really think that that's going to be the same going forward because this is kind of unusual items that aren't part of our core business. For example, we have other income, gain and loss on investment. So we sold something, possibly investments in stocks and bonds. We're not in the business of selling stocks and bonds. We sell guitars and do guitar lessons and whatnot. So this is a gain that we did have. It's income, but we're not going to put it up here in normal income because it's not part of our normal operations. So if you want to see our normal operations, you have this stuff, and then you got this thing that happened right here, which was a sale of stock and bonds, which isn't going to happen in the future. You can't really project that that's going to happen out in the future, and therefore we're going to put it down below. And then we have our interest expense, which is something that we pay on the loans. This is an expense on the loans. So this is something that we might have going forward because we might need further financing, and therefore you might have it up in the ordinary kind of area up top. But it's also not part of our normal operations. It's a financing thing. It's not, if we had the financing, then of course we wouldn't have the interest expense. It's just a matter of, it's a financing type of option. So we're going to say, hey, look, this is our performance based on our operations, our normal basically operations. This is something that's over and above the operation or different than the operation. Those are financing needs. So therefore we're going to put them down below. And that'll give us, of course, our total net income number. That's our performance. That's how we did in this case over the year's time period. And if I was to then look at the balance sheet, that is going to be included then in the balance sheet here. So it's included in the balance sheet right there. That number then that's in net income will roll over to the equity section. It'll be part of this equity section in the next year. So if I change the date one day up, refresh, now it's in the equity section. It's part of that 84,028. Notice if I look at the trial balance, stacking the balance sheet on top of the P&L basically, trial balance here, we've got all the same accounts. It's much more condensed. You can basically see it, in a much more condensed fashion down here. And you've got the balance sheet up top. Last account on the balance sheet is that 77,896. If I go to the balance sheet here, back one day, I'm going to go back to the prior year. There's the 77,896, and then you have that 613243, which is of course the income statement. Now it's broken out. So we got the balance sheet before equity before we roll everything into it, and then the income statement, which is revenue minus expenses. Here's all the revenue accounts minus the expenses. It's in the format of debits and credits, but you can see that revenue minus expenses means it's going to come out to the profit of the 613243, and that's why the trial balance is basically in balance. So you can see how the balance sheet and the income statement is the trial balance, which is the general ledger report for all accounts that are currently in use, that have actually been active during the time period. All other reports in general will be giving some more detail on line items on the balance sheet. Some of the important reports for the profit and loss is going to be saying the income, give us the income by what we sold, by item. Give me the income by customer, who we sold it to. Could be some important like sub-reports that we'll have for the income statement. On the expense side of things, again, we might want to break out the expenses by who we paid, by vendor, or possibly what we paid for in the expenses, although this description gives us some idea of basically what we paid it for. So we can do that with basically the subledgers that will support some of the line items that are on the profit and loss and on the trial balance. So just remember that every time you enter something, if we go to the home page, every time you enter something in the home page, a form, you then want to see what the effect of that form is on the major two reports, balance sheet, income statement, which you can also see in one document on one report, on the trial balance if you so choose, same thing. So that's the first place you want to go, and then think about any other report that will be affected. So you don't want to be, that's how you want to branch it out, right? You want to be going, okay, what's the effect on the major two reports? And then can I start thinking about what the impact will be on the supplemental reports that are supplementing some line item on the profit and loss and the income statement.